Countries export to the United States, they're not getting imports, they're getting dollars. And because the US is the reserve currency, those dollars are actually valuable. And so our trading partners are content, or have been in the past, to exchange the products that they produce for the money that we print. Now, their willingness to continue to do that and pursue this arrangement, I think, is coming to an end. I think the world is going to tire of exchanging real goods for our paper, especially when they understand how much less that paper is going to be worth in the future than it is now, when they realize the box that the Fed is in with respect to its ability to control inflation, and the fact that government deficits are going to keep on getting bigger and bigger and bigger, putting more and more pressure on the Federal Reserve to monetize those deficits.
The U.S. will soon be deprived of the leverage it has been enjoying for years. Peter Schiff has warned that now, China is preparing to sell an asset that will tank the U.S. economy instantly. But what's that asset? Why is China thinking of selling it at this particular moment? And how can it hurt the U.S. economy? Believe us, now it's going to get really haunting for the U.S. and its economy. For years, the U.S. has maintained order and kept itself on the surface, no matter how big the crisis came. But now the leverage it had gotten is going to vanish. Interestingly, China is going to be the country that will deprive the U.S. of all its superiority and influence. You won't listen to this news anywhere else because the Fed doesn't want you to know this. However, Peter Schiff cannot stay silent on this. He is the founder of the Euro-Pacific Capital Incorporation, author, analyst, and chief economist, who is seeing a painful possibility hitting the U.S. soon. Watch the video to know what Peter Schiff has to say. Let's get started. Every country has its foreign reserve, a collection of various assets and foreign currencies for trade and influence. Generally, countries use this foreign reserve to create a backup if their own currencies start to drop. Plus, this foreign reserve is also used for trading. Usually, countries choose those assets and currencies whose value would either increase or stay, at least, stable over the long term. That's the reason why the majority of the countries have been holding US dollars. Countries like China, Russia, and even European countries have USD in their foreign reserves, which keeps the USD on the surface, no matter how much more the Fed prints. Russia became the country that exchanged its US dollars and other assets and currencies, not to get influenced by the US. However, China is still the country that holds vast amounts of US dollars. And everyone knows that China sells its products to the US and doesn't buy the same worth of products from the US. Trade meant to start a system where countries could buy quality and efficiently produced products from other countries, and in return, sell their own produced products. Thus, compensation takes place. However, China doesn't follow this because it sells more to the US than it buys back. This allows it to accumulate US dollars in its reserves, which the US directly pays it. But this has been beneficial for the US for the past years. It could get actual quality products from China. However, instead of giving real products, it could just print more money and pay China. China was giving products while getting papers in return. Here's a little reminder to like the video if you were loving it. And if you don't want to miss videos about the evolving economics and the financial order, subscribe to our channel. Let's continue now. Simply, the US Fed could print as much money as it wanted and buy the products without increasing inflation at all. Inflation increases when you print more money than the products you have. However, when China offers you limitless products, there will be no shortage and the prices of products won't increase. That's the leverage the US has been enjoying, until now. Already, people in China are replacing the US dollar because they can earn more interest rates if they deposit their money in yuan. Fortunately, the Chinese banks have been buying those US dollars and holding them in reserves. In other words, Chinese banks have abundant US dollars. Listen to what Peter Schiff said.
Clearly, most of the foreign currency deposits in China are in US dollars. And so now when Chinese banks take US dollar deposits, they can't make as many loans. They have to hold more dollars than they had been holding. And so the idea here is that this is going to increase dollar demand in China because the banks are now going to have to buy more dollars or hold on to more dollars, so not sell as many dollars. But I don't think this move is going to provide any significant support to the dollar. The question is this an indication that the bank is going to do more to try to slow down the dollar's decline, which I think would be a mistake. I think monetary authorities should let the market function and let the dollar fall, the dollar is going to be falling against a lot of currencies, not just the yuan. But one way that this might backfire, if the goal of the policy is to strengthen the dollar, is if Chinese banks, which now have to hold more dollars in reserve, and so they can't loan out as many, maybe they will also reduce the interest that they pay their depositors on their US dollars, because obviously they can't make as much money loaning out those dollars. And if they do that, then that will simply widen the disparity between what you can earn on your RMB deposits or yuan deposits versus what you can earn on your dollar deposits. And that may cause more people in China to decide that they'd rather bank their yuan than dollars. And so what they end up doing is selling their dollars so that they can convert their deposits to yuan and earn more interest. Now, this is going to happen anyway as the dollar really starts to fall and the people in China start to perceive the risk of holding dollars, and they would prefer the safety of owning local currency. So that is going to happen anyway. But also, there's been a lot of people who have pointed to the Chinese currency peg, and they said if it wasn't for this peg, it's the Chinese yuan that would fall. That somehow by pegging the currency to the dollar, they are having an artificially strong currency, but for that peg, the yuan would crash. Clearly, when the central bank is intervening to support the dollar, that's not true. It's the dollar that's going to crash if China pulls the peg, not the yuan. And in fact, the main reason that the FX reserves are so large in China is because that's how many dollars they've had to buy to prevent the dollar from falling and to artificially suppress their own currency. And so I think that domestic purchasing power is becoming far more important than exports to the United States. And so trying to artificially suppress the purchasing power of their own currency is no longer a primary concern. They're going to have a lot more people to feed and to take care of, and so they want more purchasing power. They want to try to see the cost of raw materials and all the things that people are going to need. They want to see these things come down, and they're going to be more concerned about satisfying the demands of their own population, which is now going to really start to grow, as opposed to satisfying the demands of the American population, which is now in a lot of trouble because we're going to be fending more and more for ourselves. And we do not have the capabilities of doing that because over the years, we've grown dependent on countries like China. And so our economy has disintegrated. Our industrial capacity no longer exists. We have seen the economy transform into a service sector economy where consumers borrow money to buy stuff they didn't buy, but all this is dependent on the reserve status of the dollar and our ability to import the stuff that we didn't make and borrow the money that we didn't save. If you think about, again, the classic Milton Friedman inflation, which is what inflation is, which is too much money chasing too few goods, you print more money and it bids up the supply of goods. What has been happening in the US economy? The Fed prints all this money, yet that money doesn't lose a lot of value. Look at the exchange rate of the dollar versus other currencies. We've had this massive explosion of money printing, big increase in the Fed's balance sheet, but on a relative basis, the dollar hasn't lost a lot of value relative to other currencies, despite the fact that we've dramatically increased the supply. Imagine if the United States existed as an island. We didn't trade with any other nation. So any money the Federal Reserve printed just stayed within our borders. It didn't go anywhere, right? And so the only stuff you could buy with the money the Fed printed was the stuff that we made here domestically, because that was the only source of goods. Well, obviously the effect would have been much different, because if the Fed prints a bunch of money and we don't have any stuff, we're not producing, we don't have factories making stuff, then the prices are obviously going to go way up. But there was kind of like an escape valve that allowed the Fed to print a lot of money and it not push up the price of goods. And that was the fact that we have a whole world out there that was able to produce the goods that the US economy couldn't. And we were able to take all the money that the Federal Reserve printed and then use that money to buy all those goods that were made outside the United States. So the Fed prints money, the government gets it, sends it to Americans. Americans take that money and buy Chinese goods with it. And now the Chinese send us their goods and we send the Chinese our money. So the money the Fed creates is shipped abroad. So it's not in America, bidding up prices, but now the goods that the Chinese produced, they get shipped to America. So now we have all those extra goods to keep a lid on prices. And if you look at the breakdown of the CPI between goods and services.
But now things have started to change. Here's how. China has started realizing that it has been exporting its products to the US in return for US dollars that are just paper if they aren't spending. Not only that, but when China gets and accumulates US dollars, it helps the US stabilize its economy and avoid inflation. In other words, the US gets the scapegoat it can give its inflation to, and China accepts it happily. However, this also gives China a deadly crucial leverage as well. Since China has been accumulating US dollars for decades, it has gotten the most valuable currency on which the survival of the US and its economy depends. If more of anyone else's country's currency goes to another country, the economy of the first country starts to get into the red zone. The reason is America will become a country that wouldn't have its own currency. China, unknowingly or deliberately, encouraged the US to print more and more US dollars and acted as a black hole that would store those dollars. This helped the US print more money and avoid inflation as well. However, imagine what if China drains all the US dollars in the market? What if it decides to eliminate the dollars that have been losing their value? China now realizes that it has become a country that has bought the liability in the form of US dollars. The one who will have the US dollars in abundance will be the losing party because it keeps inflation away. If China weren't there, the US would face high inflation because there would have been an excess supply of US dollars in the market. But China kept those dollars. But now, China is thinking of getting rid of them. China is getting the news that the Fed is actually giving up on the US economy. Therefore, holding the US dollars will be the worst decision. Therefore, China will immediately sell all its US dollars. It should be noted that dollars won't be sold gradually because the moment China starts to sell, it will be when the dollar value starts to decline. Therefore, it will be an instant sell-off that will bring havoc to the US economy. Within no time, the international forex market will flood US dollars, devaluing the currency. On the other hand, since those dollars would be in the market, prices of goods and services in the US would rise dramatically. It would be like balancing the inflation rate that was frozen for years. Peter Schiff said that this threat is the biggest of all for the US economy. The high inflation we are having now and the slow market is nothing compared to this. All other threats aren't as strong as sinking the US economy. However, when China drains its dollar reserves into the market, the US economy will be in shock, and a collapse will be the ultimate result. Peter Schiff said that the Fed chairman and no economist in the US is thinking about this brewing threat. Listen to what Peter Schiff said.
To pay for your imports. But what about America? You've got China and other countries exporting to the United States. They're not getting imports, they're getting dollars. And because the US is the reserve currency, those dollars are actually valuable. And so our trading partners are content, or have been in the past, to exchange the products that they produce for the money that we print. Now, their willingness to continue to do that and pursue this arrangement, I think, is coming to an end. I think the world is going to tire of exchanging real goods for our paper, especially when they understand how much less that paper is going to be worth in the future than it is now, when they realize the box that the Fed is in with respect to its ability to control inflation, and the fact that government deficits are going to keep on getting bigger and bigger and bigger, putting more and more pressure on the Federal Reserve to monetize those deficits. And in fact, the reason that the deficits were able to get so big in the first place was because of this arrangement, because foreigners were willing to hold on to our US treasuries and keep interest rates artificially low. That emboldened the government to go even deeper into debt, because normally a government that was this profligate would be punished by higher interest rates, and that punishment would change their behavior and cause more fiscal responsibility. But we never got punished, and as a result of that, we continue to pursue even more reckless policies than we had in the past. And so foreigners actually helped encourage this, and ultimately now they're going to be the ones that are going to put on the brakes, because they're going to stop enabling all of this debt. But it's going to be the Federal Reserve that is going to ultimately replace foreign buyers of US treasuries. But of course, when foreigners buy US treasuries, there's no new dollars created. They buy treasuries with the dollars that already exist. But when the Federal Reserve has to buy those treasuries, they have to produce even more dollars to finance it, which is inflation. And of course, if those dollars stay here, if they're not exported, then they are going to be bidding up prices. And this is what Powell doesn't understand.
What do you think? Will China lose its trust in the US dollar and sell them all? What if China does so? Will the US economy tank instantly? How can the Fed avoid a situation like this within no time? Comment your opinions in the comments section right below. Do you want to watch more videos like this one? If yes, please like and share the video and subscribe to our channel for more videos on the latest economics and financial news. Until the next video, stay tuned.